Hello, everyone. Today on the final bar, happy Friday afternoon. We're going to wrap the week. Every Friday, we love to make sense of the markets from a big picture perspective. Our weekly wrap show is where we go through the Mindful Investor Live chart list, go through each of those macro charts, looking at breadth, sentiment, price momentum, just try to see where the world has evolved, not just in equities, but in other asset classes as well. As you're going to see, equities doing just fine. And today's rally certainly propels us to go ever forward. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Friday edition of the Final Bar today. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to try and make sense of these markets together using the lens of technical analysis, behavioral investing, decision-making, all those good things. As we've talked about many times, the value of charts, in my opinion, are visually representing what's happened to the markets and how those trends are evolving. It's never about knowing what's going to come tomorrow. We never will, but so it's never about certainties. It's always about probabilities. What's the most probabilistic outcome for the assets that are important to us? And charts, I think, a lot of times provide the ideal way to see where we've come from and anticipate where we could be going next. And today, boy, the equity market's firing on all cylinders, energy driving the way higher. So we're going to dig through a lot of those themes going forward. So I want to point out some of the great guests we have coming up on StockCharts TV in the next couple of weeks, and especially on this show. Monday, on our next episode of Behind the Charts, we're going to feature a conversation with Price Headley. Price is an expert in the options market, and really appreciated sitting down with him, learning about how he got into options, how he thinks about the risk side of it, not just logistically managing risk using options, but also mentally, the mental game of investing, not just for options, but for any asset class. It was a really cool conversation. Then we have some great guests on this show. We have Dana Lyons next Tuesday, the 9th. Mark Ungerwitter joining us on June 10th. And on June 11th, Xenia Taubina joining us for the first time. Also wanted to point out for you a really fantastic week we have coming up in mid-July. This is the week of July 13th. We're calling it Charting the Second Half, a mid-year perspective from stock charts. And so what we're going to do is have all of our contributors and some special guests do a lot of presentations about the first half of the year, and most importantly, what they see for the second half, what's their outlook. So the guests on my show are all going to be focused on that second half of the year. We're going to have a number of special presentations, some fantastic keynote speakers, and we'll finish the week with a wonderful market outlook panel featuring some names and faces that are probably familiar to you. So make sure you mark it down now. The week of July 13th is going to be a can't miss week for StockCharts TV. Let's get to our weekly wrap. So, recapping what's happened today, but really focusing on the big picture. So, we've talked about this, sort of bear market rally. We're going to start with the chart of the S&P 500 here. And for me, it's always been about the trend, right? It's about the trend, higher highs and higher lows. That's an uptrend. As long as we continue to do that, then the trend is positive. And if you look at the daily chart of the S&P 500, it's undeniably in an uptrend, right? A series of higher highs and higher lows. That first real higher low, first week in April, was the first of many. The only real concern we've had, if you look at that sort of medium-term time frame, looking at a couple months at a time, is this pullback here in the April-May period. And what we talked about was, is this a bull flag? Is this a big run, a parallel corrective period where we sort of digest those gains? And if and when we break above there, we had the added bonus of being right in this resistance range around 2950 to 3000, so the 200-day. And if you followed what we've talked about, that break certainly signaled higher highs. It's accelerated to the upside. And I think this has led a lot of people to question the how long this sort of move can continue. And that's totally fine. I think, again, if you look at the fact that the market's overbought, that could be potentially a short-term negative signal. Absolutely right. But what I would remind you, and this is, if I remember right, I did get a question on this. I don't know if we're going to be able to get to it in the mailbag segment today, but just because it's overbought just means it's gone up a lot. So if you look back here in mid-November of last year, that was the first time we'd become overbought in about 3 or 4 months. And if you look, it pulled back for a day or two, and then the uptrend resolved. It became overbought again, pulled back for a day or two, and the uptrend resolved. So what happens is in an extended bull phase, you become overbought and you almost remain overbought. And so it's less about the short-term tactical read. Are we due for a pullback? Absolutely. There's no denying if next week if we had a bit of a pullback to like 3,100, that would satisfy everyone. That would feel like a much healthier move. When we start going vertical, people can get concerned, rightfully so, about how sustainable is that sort of rally. But for me, I found more meaningful market tops are more about divergences like you saw here in January, February of this year, and less about just becoming overbought. That usually just means the market has gone up a lot. That's kind of where it feels like. So it makes sense to me that the market, that the S&P is overbought here. Let's look at some of the other quick themes, and then we'll get right into our the Mindful Investor Live chart list. So the S&P finished almost to 3,200. It actually was above there earlier and came back to close below 262 on a percent basis is where we ended up. Mid caps, small caps up even more. So the small cap index up 4.4% with the S&P 600 hitting around 900. The NASDAQ 100 up a little less than the S&P, but still up 2%, which is pretty decent. The VIX now below 25, down another 5% today. In terms of sector leadership, energy was really the main story today, with stocks like ExxonMobil, Chevron, and a lot of other names that you're probably that you've looked at up significantly. Big gaps higher with the energy sector, the XLE up 7.5%, followed by financials up 3.8%. So we talked about this emergence of banks. We yesterday had Greg Harmon talking about Cincinnati Financial. The day before, boy, I'm taxing myself to come up with names and tickers we talked about in the week. It's not going to come to me, but other guests this week, I remember we talked about sort of a consistent theme was talking about financial stocks and what they were doing. So the fact that the XLF is up almost 4% is pretty meaningful as well. On the downside, you have the XLU utilities, we have consumer staples, we have healthcare. Utilities being up the least doesn't concern me a ton. What does concern me is if you look at a chart of the XLU, and I'll show you that here. This is sort of the you call a shooting star pattern, which is basically you rally up, the open and close right at the lower end of the range. You have a big upper shadow or upper stem. So if you're familiar with candlestick analysis, you'd call this a shooting star pattern, which is basically open and close at the lower end of the range, a big upper stem, which means we opened, we traded much higher, we then closed back toward the lows of the day. That on its own is one thing. The fact that it happened right at the 200-day moving average, which was right where the XLU hit resistance in April, tells me to be a little bit wary about the upside potential of utility. So, short term suggesting a little more weakness than strength. This is that the relative strength has turned over a little bit, and as it's facing key resistance. So it really hasn't, we talked yesterday, I think it was one of our 3 and 3 was looking at utilities, and it certainly didn't follow through there today. The other one I would point out on a sector basis is healthcare, and this, relative weakening of the healthcare sector. Overall still up 1.6%, but this is when the S&P was up 2.6%. So, in general, it's not really been driving the market higher. It's been sort of coming along for the ride a little bit, but a lot of the names that had looked much better in the healthcare sector starting to weaken on a relative basis for sure. The other big stories, looking at this week, and then we're going to get to some other things, are the emergence of some of these stocks like American Airlines, Royal Caribbean, gapping up today in a big way. Sort of these recovery names, travel, tourism sorts of stocks, really rallying. American Airlines was up pretty significantly yesterday. Certainly seemed to follow through today, and at one point earlier in the day broke above the 200-day moving average. But if you look, we closed way back down almost into yesterday's price range. So this comes as it was overbought, nearing that extreme overbought region, but overbought at the 200-day and not able to close anywhere near that. Sort of speaks to a little bit of short-term weakness coming in. So, again, this group is up huge. The relative strength has exploded to the upside. Today's, sort of trajectory of gapping higher, but then closing back and filling that gap intraday does not usually speak to a lot of strength going on. That feels like a lot of people that got in and took profits on an early gain today. So whether that has staying power is a real open question. You know, a new chart I wanted to put together, I was just thinking of how to best illustrate the relative movements of the different major asset classes, and we went above the viewable area. That tells you how much crude oil was up by the end of the day today. It went off the screen here. But this is basically looking at some of the major asset allocation decisions I would be thinking of and where they all ended up. This is just starting the clock last Friday and just looking at the 5-day returns. And again, don't read too much into that in terms of bullish or bearish outlooks, but it's just trying to define where we came from. So crude oil, the biggest gainer out of all of them, up over 11.5% through today's close. Small caps number 2 up 8%, the S&P up 5%. So it's interesting that on a week that the S&P really improved, really rallied to the upside, small caps up even more. And this is a very different configuration than what we've seen up until recent weeks. It had been a mega cap led move led by those big consumer and really not as much consumer, but more communication services, definitely technology stocks like Microsoft. Look at the relative strength of Microsoft. It's come off quite a bit as other sectors, other groups have really emerged in more of a position of strength. Bitcoin actually at one point led the way on Monday back to finish up around 3%, but really not, tripping higher. A lot of these risk on assets did. Bitcoin certainly taking a different track, and the NASDAQ 100 up 2.7% through the end of the week. 3 of these assets were down. The dollar down 1.5%. We talked about some of the weakness in the dollar and the inherent strength in emerging markets, international stocks. I was talking with Ms. Schneider earlier today. A couple weeks ago, had her talking with her about international stocks and looking fairly attractive. So weakening dollar certainly buying into that thesis. Gold down 3%. This has been one of the better longer term charts, really starting to evolve in terms of the precious metals. And then bonds down the most, down 4.5% about. So certainly this week was more about risk on versus risk off. Things like bonds and gold down, the dollar weaker, and all these other risk assets going to the upside, with crude oil leading the way, and energy you saw up the most today. Let's look at the Mindful Investor Live chart list. We're going to start with what I call the market trend model, which is looking at the big picture trend. I run this model on all the major asset classes, but we'll focus here just on equities. So for me, the long-term model is looking at the 21 and 34 week moving averages. It's so close to tripping, and next did not get there today. I can see next week it actually tripping positive. The short-term and medium-term reads based on the weekly PPO or the weekly MACD, both have been positive from late March, through early May, which is when the short-term and medium-term trends both turn positive. So both sort of firing on all cylinders. And again, the question is, what happens to this trend? The gap higher certainly surprised me and others, just the resiliency of this uptrend. But at some point between early April and now, I think you had to have seen something that convinced you to turn positive. I really waited overall, and still, again, years from now, this could be the first corrective wave after another big wave down. But in the tactical time frame that I'm paying attention to, you have to acknowledge the uptrend in stocks and its ability to break out above its 200-day moving average on any pullback. 3,000 is the line in the sand that I would hold to pretty well. I think that's a fair object to look at. All the weekly breadth indications, for the most part, that I follow have now turned positive with the strength in stocks, and all 4 of the cumulative advanced decline lines have turned positive in the last 5 to 10 trading sessions, which is really worth noting. And small caps, the last one to break positive, has now done so, confirming the uptrend that we've seen. We haven't updated this yet for the end of the week for Friday's session, but I again have talked about the increasing number of new highs. I'd love to see that continue on. It'd be interesting as we lock in Friday's closing values on all the stocks and see how these update, how much that participated in the uptrend. But I would sense that's probably going to continue to go a little bit higher. Looking at breadth, yesterday on our 3 and 3, we talked about this chart, the percent of stocks above the 200-day in the S&P 500, breaking above 50%. And I don't know when, but somewhere along this way, I remember saying, as the percent above the 50-day improved so much, I remember saying, look, until we get over 50% of the S&P above their 200-day moving average, I don't know how much staying power this rally is going to have. We're there. It's like I can't come up with any more things we haven't done yet. We've kind of done it. That on its own, I tweeted that out earlier, and the response I got was, you might have called the top right there. I hope not, but maybe. Again, everything's sort of rotating higher. In terms of sentiment, to switch gears just a moment, If you look at the AAII rankings, something I like to look at every week, this came out yesterday, so it's not updated for today, but there's been a narrowing of bulls versus bears almost to the same level. There's only 4% more bears than bulls here. That's down from 30% more bears than bulls just about 5 weeks ago, right? So that's a huge rotation. That's one of the lowest numbers we've seen in quite a while. We're now almost back to the zero level, and it shows you how much individual investors have rotated and bought into it. Still, though, only half of respondents bullish, or a little under half if you look at the two of those. The rest obviously in the neutral bucket. We focused a lot on ratio analysis, so if you missed the episode yesterday, I'd encourage you to go to Thursday's episode to see that. But we focused on things like the relative performance of semiconductors, consumer discretionary versus consumer staples, consumer discretionary versus tech. All of those things I think are very important to pay attention to in terms of this rotation away from mega cap tech into other places that have really emerged in strength, especially finance, especially energy. And I'll finish off by just pointing out that small caps have really rallied in a meaningful way on a relative basis. That is a very different feel than what we've had for quite a while. And sorry, one more chart. I keep saying one more chart. This is honestly the last one. Growth versus value rotating lower. I still think it's a little early to declare the end of the growth trade, but this certainly indicates a rotation away. This is the biggest downturn in this ratio that we've seen in over a year. Has certainly been favoring growth. You can see this is now rotating below the 50-day average for that reading, and suggesting that the value trade starting to emerge as some of these sectors that we've written off mentally are starting to emerge and perform very well. That is our weekly wrap for today. A lot of really interesting charts, and again, a resilient equity market that certainly deserves your attention if you haven't focused there yet. We'll take a quick break, be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, your questions are so fun to get and fun to read and fun to answer on the air, which is what we're going to start momentarily. If you have anything coming up as you review the markets, review the charts, look at your portfolio, look at your watch list, just shoot us a question via email, thefinalbar@StockCharts.com. Also on Twitter, just tag us in a comment @FinalBarSCTV. We gather all of those. We've had so many great questions from so many of you, and we really appreciate it. Love to keep hearing from you and make this show as interactive as possible. Let's get to the Final Bar Mailbag right now. So I had a number of questions in the last day or two, and I'm going to try to get to as many of these as I can. Question number one. As a high school science teacher, I can appreciate the time and effort you and your colleagues at StockCharts.com do to educate others. Thank you. It's very, very kind, and you're welcome for sure. The systematic approach of technical analysis appeals me. I can't help looking over my shoulder at valuations, and I'm seeing lost opportunities, right? Things were undervalued and I missed them. So the question is this: would a professional technician be considered undisciplined for considering fundamentals? Great question. What does a technician do when the charts say buy, but the fundamentals say not so fast, or vice versa? It's such a really good question. And I will tell you, in my time as an institutional analyst working at a large money management firm, we focus very much on what we call fusion analysis and really combining technical and fundamental disciplines. One of the screens we did, if you incorporate quantitative analysis as a third discipline, so you had fundamental, technical, and quantitative, we actually ran what we called the thrice blessed screen, or the triple aces screen, triple aces, which is basically all three methodologies were bullish on a particular stock. So we would every week run this report and look for stocks where the fundamental, technical, and quantitative analysts, using their own process and not really looking at the other disciplines, what they liked, and that trifecta, that all three agreeing, ended up being a really good group. And that group of stocks over time outperformed any one of the individual disciplines, which was really interesting to watch. I found, though, one of the more interesting conversations I would have with one of the money managers was when there was a disagreement, which gets to your question. With the chart looks very good, but the fundamentals look very weak, or the fundamentals look very strong and the chart looks very weak. Now, as a technical analyst, I will tell you, if you're going to follow one thing, I would follow price, because the price tends to lead the move. The fundamentals tend to become more and more clear in the rearview mirror. Later, once a stock really tanks, you will find what are the reasons that caused some of the issues. It'll become more and more clear as the company has to report what's going on. But investors getting nervous about the situation a lot of times will get ahead of that, which is why a stock will roll over a lot of times before the fundamental story sort of comes out that tells you why things are a little weaker. So the short answer is this. Is it worth following fundamental analysis? Absolutely. Would I feel comfortable buying a stock knowing nothing about what the company did or nothing about the fundamental structure? Absolutely not. Is it a problem if your fundamental analysis pollutes what you're doing with the technical analysis? That is a problem. And so what I would remind you is, remember, if you know a company well, if you know Royal Caribbean well, and you know the story and you know the management team and you know the things, don't have that be part of your process as you're looking at the chart. Don't look at the chart and think about the management team and the products and reopening and how that's going to go. Look just at the chart and then compare that back to your fundamental thesis. And then I think you're using the two very, very well. Next question. I've been trying to identify pullback indicators. I think I'm onto something. When I look for weakening price action, that's what I find, at least in my main question. How do you look at breakouts and pullbacks are within a larger price action? This is the chart that you sent. I hope you don't mind me showing it here to everybody, but really well done. And so, the question was just, with this sort of thing, how do you make sense of these shorter term fluctuations, the breakouts, the pullbacks, versus the longer term trend? And for me, I think this is one of those benefits of technical analysis. You can actually use it across different time frames. If you think about my market trend model that I often talk about, it has 3 time frames. It has the long term, which is a year plus, has the medium term, 3 to 6-ish months, and then the short term, couple days to a couple weeks. And the markets comprise all 3 of those. And in general, if you look at the data in the equity markets, the best stocks over time to tend to want to buy would be stocks that are in a positive trend longer term and a weaker shorter term trend. That's what the data actually supports. We call that buying on the dip. So in general, broadly speaking, the charts, the sweet spot for a chart, in my opinion, would be a good long-term trend, but something that's pulled back to a meaningful, buyable level, a support level of sorts. So the example you're illustrating here, might actually buy into that, where we're facing resistance, we're pulling back a little bit, the trend is positive. And what happens when you buy in on a little bit of weakness is your risk reward starts to get a little more attractive because you're buying a little lower in, and then you have the potential upside of returning to the previous highs and before. And when you enter this sort of position, that's where you have to be pretty disciplined about setting your upside objectives, setting your stops, and staying true to that and identifying it. So I think where you're illustrating breakouts and pullbacks, I think that's fantastic. And you're illustrating key support and resistance levels. I think, in this example, 380, which was the previous highs where we hit there, that's a great first support level. If we break below that, sort of your, cut and run level could be around 3 or so, which would be the lows from this sort of previous pullback. Because as long as the stock is making higher highs and higher lows, the uptrend is in place. So I think the way that you're thinking of that sounds pretty good. And again, the more you attempt those, the more it'll make sense. Next question. I've overheard you say that an overbought RSI in and of itself really isn't a sell signal. Is there an indicator you would use in tandem with the RSI that would strengthen the evidence for a sale? It's a really good question. And I sort of addressed this a little bit earlier, talking about the market environment. I'll show you the S&P first, and then we'll get to your example with eBay. So, the challenge for the S&P 500 is we have become overbought. The RSI on the daily chart is above 70. That means, by classic definition, Wells Wilder's definition, it's gone too high too quick. As a result, you'd probably expect a short-term pullback, and that's fair. Technically speaking, what you usually look for is when it comes out of the overbought region. Just because it gets up there just means it's gone up a lot. That doesn't necessarily mean it's bad. What you'd want to look for is when it pulls back out of that overbought region. A lot of times that will coincide with a short-term pullback. But in general, what you have to remember, especially in the equity space, which is where I've tended to focus, stocks will become overbought and remain overbought for quite a long period of time. And so just because it's gotten up there, that doesn't necessarily mean the top is in place. So what do you actually do about that? So for me, as you can probably tell, I'm more of a trend follower. So it becoming overbought just means it's gone up a lot. I'm happy with that. When it pulls back, I'd love to see if it remains above its previous swing low. As long as it does, I'm happy there. Here is where it starts to be a problem, which is we've become overbought. We've now gone below the previous support level. We've now made a lower low. Once we make a lower high, if you're not completely out of that mentally, I think you need to start considering that way. So, for me, the overbought condition is what puts it on your list. the breakdown, the confirmation, and whether it's a price breakdown, the PPO is very good for that. And that's probably how I would answer your question. I'd use the PPO as a trend following, as a lagging indicator, confirming that the price has gone lower. I think that's interesting. The example you asked about in particular is eBay, though. And the thing with eBay is it's become extremely overbought, which usually means it's an RSI above 80. It's gone up so far, so quickly, you'd expect a bit of a pullback, but overall, at least one further leg higher. And I think that's what, for eBay and a lot of other stocks like that, I think that's what would support a bit of a pullback, but then a little further upside because they've become extremely overbought here. Last question, and boy, these are fantastic questions, guys. Thank you so much. Can you explain why the stock market is valued as if the coronavirus never existed? Such a good question. And I will tell you, it's been a fascinating journey through this period. I mean, it's been challenging for a lot of reasons. I think there's a lot of, obviously concerning events happening in a lot of places right now. And so I don't want to minimize that by any means, but just thinking purely as a market analyst, I've talked with a lot of peers, my peers in the industry here in the last couple months, really, since things really started to shut down in February and March. This is such an unusual period in that the percent moves are not unusual. The fact that the stock market goes down and loses 30% of its value is not unusual. That's happened a lot. The fact that the market will recover from that sell-off is not unusual. That's happened a lot. What is very unusual is how quickly all of that has happened. The time compression has occurred, meaning things are taking much less time than they have in previous cycles. And that's what makes it sort of an interesting, different environment. So, can you justify where the market is? Remember, the markets are all about forward-looking expectations. The economy is very different from the market. When you're looking at asset prices, that tends to be a leading indicator for the economy and not the other way around. So while you still see a lot of concerning economic data, the resilience in stocks should speak to the fact that the economy is improving, or people's expectations of that is going to happen. What tends to be the end of this sort of move, a bear market rally, if you will, is when the market gets ahead of the expectations and when things get too frothy. And so can we justify getting back to 3,400? Apparently, because we're getting there. Could you justify going meaningfully higher than that? Are things better than they were the first quarter of 2020? Hard to argue. And that's where I think, to your point, I think it's fair. And I think that's why a lot of strategists are speculating as to when we would see a meaningful pullback from here. And again, for me, I'm gonna buy into that when I see the prices stop going higher. Those are some fantastic questions, you guys. It's hard to answer some of those so quickly. I hope you found that helpful. We need to wrap the show though and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P market trend. We talked about this in our wrap the week segment. Just as a reminder, from my perspective, the short-term trend has been positive for a while. The medium trend has now been positive for about a month. The long-term trend, by my definition, really, really close, has not turned positive. If we would close higher next week, that's most likely going to trigger into a positive signal as well. And what I found using this model for a number of years, and I started following this back in around late 2000, before 2010, which was after during that sort of secular bear market period in the first decade of this century, and at that point it was a secular bear market, and these signals were absolutely perfect. In a secular bull market, which is what we've been in, I found it turns negative and then resumes in the positive, and overall it's been leaning more positive. So how it will go from here, I can't make any guarantees, but certainly continuing to appreciate here. Chart number 2 is the cumulative advanced decline lines across the cap tiers, and I think it's just worth noting this week now all 4 of them have turned positive. Over the last week or so, they've one by one turned positive, and now they're all leaning to the upside, with small caps confirming it yesterday, and most likely these lines all going higher through the close today. So certainly from a breadth perspective, market firing on all cylinders and continuing to be fairly positive. The third chart I would share with you for today is just looking at 3M as an industrial, as just an example stock here to show you, I think, the challenge we're at right now. This is a stock that's now nearing its high from earlier in the year. It's broken above the last resistance level, and this had great resistance from the first week in February to where we saw here late April. We've now broken above that with today's session, which means higher highs, higher lows. The trend is in place. It's now overbought. And one of two things happens. This is the beginning of much further upside as the momentum increases, or there's a bit of a pullback to these levels. Based on the fact that we're overbought, based on the fact that we've had such a good run, I wouldn't be surprised if we get a pullback to some of these 200-day moving averages, but We'll have to wait for the price to tell us that. Folks, that's our show. I want to thank you so much for joining us on the Final Bar every weekday after the close. Check out all of our previous episodes on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.